18 months ago, growth equity investors got crushed by the tech market collapse. Valuations have plummeted by 30, 40, even 50%, and deal-making has come to a near standstill as investors wait for their portfolios to recover. But my guest on today's show argues that the waiting game may soon be over.
We're already seeing a great valuation reset.
That's Tom Callahan, the Chief Executive Officer of Nasdaq Private Market, a secondaries marketplace for private assets.
Investors holding on to peak valuations of 2021, kind of closing their eyes and hoping the market would come back. And I think they're starting to say that, assets need to clear the market at where the market is today, Hugh, not where it was 2 years ago. So the valuation disconnect is really starting to close.
Today on Dry Powder, I'll ask Tom how investors are using the secondaries market to solve the bid-ask spread problem. We'll also explore whether the valuation crisis could truly unlock liquidity at scale.
It's really a market that is in desperate need of maturity, infrastructure, and standardization. And one of my board members has called this the Mount Everest of market structure challenges. And for me, honestly, Hugh, it was just too good of an opportunity to pass up.
I'm Hugh MacArthur, chairman of Bain's Global Private Equity Practice, and this is Dry Powder. Tom, I'm cognizant that a lot of our listeners may be less familiar with Nasdaq Private Market than exactly what you do for investors. Could you briefly explain that for our audience?
Yeah, so Nasdaq Private Market was started within Nasdaq back in 2013. It was shortly after a piece of legislation that I'm sure you're familiar with from 2012 called the Jobs Act. Really the starting gun, if you will, that kicked off today's private markets was the Jobs Act under President Obama, which really did liberalize the ability of private companies to take on new shareholders. There used to be a cap at 500 shareholders. So if you hit that cap as a private company, you were kind of forced to go public. And so 20 years ago, the average company IPO'd at about 5 years, because that's when they kind of hit that ceiling, if you will. Nasdaq got concerned, what if this legislation means that some companies wait longer to go public? Well, fast forward now 11 years, where the average private company waits 15 years to IPO.
Mm-hmm.
It was a very valid concern. And so the initial product that NPM created was something called a private company tender. And prior to that, really private companies didn't do tenders.
Mm-hmm.
So again, if you're going to wait 15 years to IPO, if you're hiring 25-year-old engineers, it's kind of hard to say to them, well, you should wait till you're 40 to buy your first house or pay off your student loans.
Mm-hmm.
There has to be a way to monetize the equity grants that they're given at some point before IPO. So the private company tender is where we go to private companies. We offer to run a tender where their employees get to monetize part of their vested equity holdings. Maybe they can sell 10 or 15 or 20%. And that really is an important retention tool for those companies. We spun out of NASDAQ in 2021. And really the idea behind the spin out was that, concurrent with this incredible growth of the private secondary market, the demand for liquidity away from scheduled company tender programs really has grown immense. And the largest banks in the world really didn't feel like they had a trusted institutional platform to transact private secondaries. And that's what we've been building, is all of that infrastructure to have a high integrity platform to trade private company secondaries. So that's what we do.
So where are you seeing surges of interest, and are you seeing surges of interest at Nasdaq Private Market today, given the realities of the fundraising environment, which is pretty harsh out there?
Well, it sure is. And we are seeing a surge of interest. I'm not sure we're seeing a surge of activity just yet, but I think that we will. And I think you just have to, again, zoom out a little bit and look at how did we get to where we are today? And we had massive growth in valuations in 20 and 21. And now we're dealing with frankly, the hangover after the all-night bender. There are hundreds and hundreds and hundreds of private companies that are experiencing a very aggressive valuation reset. You're seeing it really acutely in the VC community, because the whole VC business model, as you know, depends on liquidity events. Well, as we sit here today with the IPO market, for all intents and purposes, closed, M&A at 15-year lows, there are no distributions. There is no liquidity. So you've got this incredible volume of trapped capital where investors cannot get return of capital, where investment managers and GPs can't generate liquidity. You've got employees of private companies who oftentimes have, relatively modest salaries, and a big part of their comp comes in shares, and they haven't been able to sell shares in 2 or 3 years to lead their lives. And, opportunity always attracts new capital, and people are looking at the incredible discounts available in the secondary markets now. So all of that, I think, is going to come to a head in the next 12 months, which is why this is a space that I think a lot more people should be paying close attention to.
So you mentioned there are a lot of obstacles to liquidity out there. The IPO markets are shut, valuations are down. These companies need capital. LPs would like some capital back. And we've got a machine that one of my favorite clients calls the Rube Goldberg machine of investing, because it is the most complicated thing imaginable to do something that's actually quite simple in theory.
That's the perfect analogy for how the private markets work today.
Are there other obstacles that you're seeing to liquidity?
I mean, the valuation issue is probably first and foremost. I'd say the other challenge is there are impediments to liquidity in private markets that are very much there on purpose, i.e., these are features, not bugs. What do I mean? Oftentimes, private companies themselves put terms into their contracts that prevent investors and employees from selling their shares. The company itself stands in the middle of every transaction, and that's written into their documents that they have the right to do that. What does that mean today? Private companies are blocking share transfers. Why are they blocking share transfers? Well, because when large institutional investors transact in blocks of 50, 100 million, it really does reset a new value in their company, and they may not want that. Mm-hmm. It's sort of the equivalent of a public company CEO calling the floor of the New York Stock Exchange and saying, "Good morning, don't let my shares trade below $17 today." I mean, it's sort of absurd to even think about, but in the private markets, that's exactly how this market operates almost every single day. That's probably the second issue after valuation that we're dealing with. And then finally, I would just say that this is an incredibly primitive asset class, and none or very little of the basic plumbing that allows every other asset class on planet Earth to function efficiently. I'm talking about data, clearing, settlement. Settlements typically take about 3 months.
3 months.
3 months from the point of transaction to settle the trade.
Wow.
And sometimes they fall apart, and you've got counterparty risk. It's just an incredibly primitive, immature market infrastructure, and we're trying to change that.
So, Tom, can you share some of the creative solutions investors are using to address the bid-ask spread problem that you referenced earlier?
One of the phenomenons that we're seeing, Hugh, in 2023 is of the over 1,000 unicorns in the market right now, there's probably only liquidity right now in about 20 or 25 names.
Really?
The biggest, most high profile, it's the ByteDances, it's the SpaceXs, it's the Neuralinks. But outside of that, the other 97% of private companies, it's really, really difficult to buy or sell those names right now. And a lot of that, again, comes down to the point that it's just very hard to get data and information. So I think more than some magic new product or proliferation of continuation vehicles, the simpler solution is going to be to try to create a platform where GPs can actually sell individual company names when they need to.
Do you believe that these kinds of tools and the data that you're talking about are going to effectively address the bid-ask spread problem, or are these markdowns and the valuation challenges that you referenced earlier, Tom, kind of inevitably a part of this equation?
It's inevitable, right? I mean, markets need to find a clearing price. We had the really violent correction in the public market starting about halfway through 2022. And for about the first 6 months of that experience, the private markets were, for all intents and purposes, closed. I mean, bid offers widened out to 30 or 40%, and transaction volumes dropped almost to nothing. The market was just in a state of shock. And then as we came into 2023, things started to recover, got some better performance of the public markets. And of course, Silicon Valley Bank went bankrupt in March. And that was another thermonuclear detonation, given how important SVB was to the whole innovation economy. So it's really only been, I'd say, Hugh, since about midpoint, kind of June or July, of 2023 that the private markets have started to reopen, and that capitulation is definitely happening and is a huge part of the equation.
Yes, I think that obviously repatriating money back to the LPs is going to be the forcing function that eventually unlocks the valuation issue one way or the other. But one of the issues that we've noticed and talked about that I'd love to get your take on, Tom, is that GPs may have a temptation to sell their strongest performing companies in this environment and thereby leaving a portfolio of less attractive companies, which are going to have their day of reckoning as well. How do we avoid the challenge of having all the best properties come to market now and then pay the piper later?
Yeah, it's a great question. And honestly, Hugh, I don't think it is avoidable. I talked to one of our large private company clients, the CFO, about a month ago, and he told me that one of their Series A investors, which is one of the largest and most well-known Sand Hill Road VCs, had called them and said, "We're under instructions to sell our top 50 best performing companies, and congratulations, you're one of them." So we're selling
Wow.
our positions. So there's a bit of a winner's curse, if you will, because again, back to this point that in today's market, liquidity is so concentrated in the biggest, most successful, most well-known names. And as is often the case in times where liquidity is distressed, people sell not what they want to sell, but they sell what they can sell. And what they can sell right now, frankly, are kind of the crown jewels, those best performing assets. It's one of the reasons I think that this is such an amazing time to be investing in private secondaries. You know, one large investor said to me not too long ago, it feels like buying privates in 2023 is like buying real estate after the GFC in 2009. So I don't think it's avoidable. The right question is probably, well, how do we fix it going forward so that of this, again, $3.5 trillion asset class, only 1 or 2% is liquid at any given time? And again, I think that gets back to a conversation of how do you create better data, better infrastructure, better transparency, raise investor confidence so that there is liquidity outside of just, that small handful of the most successful companies.
What sort of transaction data or benchmarks can help investors arrive at these more realistic valuations or a fair valuation?
Yeah, it's another speed bump that we face that the public markets don't. Most every other asset class, there's a regulatory requirement for a public tape. We've got tape A, B, and C. You've got things like trace in the fixed income markets. That doesn't exist in the private markets. Probably the worst victims of it are, employees that come to sell their private shares. Of course, if you're a sophisticated institutional investor, you probably have access to information and you understand where markets are trading. But if you're, a 27-year-old engineer that's just looking to sell some vested shares, you have absolutely no idea where markets are clearing. It's not like you can just pull up your iPhone and look at where a private company share is trading. The information doesn't exist. So we see in our market in 1 week, employee A will sell at $32 and employee B will sell at $21. It's just a ridiculously inefficient market right now. And so one of the reasons that this doesn't exist is there isn't that centralized data repository. So that's what we're trying to create at NPM. One of the services that we offer is something we call transfer and settlement. There's no DTCC of the private markets, Hugh. There is not one centralized settlement agent. So that's what we're trying to do. And so when we fill that role for private companies, we settle and clear 100% of their trades, which is a operational efficiency for investors and for private companies. But it also gives us the benefit of having 100% of the information of where transactions are happening in a given name. And we can then give that back to investors, to clients on our platform, so they're educated. When you go to buy or sell a house, you pull up Zillow and you get his estimate. You say, well, this is what I think the house is worth. An equivalent of that to give investors and asset owners an indication of where fair market value is, I think, is a hugely important part of how these markets move forward.
What is the big unlock, though, for liquidity, Tom? I mean, you've given some compelling statistics here. $3.5 trillion worth of assets, 1 to 2% liquidity. That's not a lot. People selling only their best assets in the marketplace right now. The bid-ask spread problem continuing. What is going to cause this situation to change at scale, so we actually have true liquidity in these private markets?
Yeah, I do believe that in the long term, regulation catches up with this problem. And in time, regulators will bring that to the private markets. But in the meantime, a lot of these friction points we've been talking about in the private markets, they're features, they're not bugs. Investors, VCs, get preferred access to investments and to the best private companies, and no one else does. So the system has been set up to sort of intentionally prevent open access. And fast forward to 2023, where those same VCs and investors now need liquidity in their portfolios, I think the rules are going to change. And as we go through this next round, this great refinancing, as private companies are coming back to market on their next series of fundraise and new unicorns are being born, and we hear this from VCs all the time, Hugh, is that this issue of transfer restrictions and the ability for private companies to block share transfers is something that I think is really going to change. And, VCs are going to basically make it so that liquidity in private shares is much more available than it is today, because that's now in their best interest. So I think that's the short-term answer. I think the long-term answer, as I said, is probably regulation is going to come to this space, because, private markets are 15% of GDP right now. It's just too big of a space to operate with this kind of primitive level of regulation.
I knew this would be educational. It's a really interesting space. As you noted, very, very large, 1,000 unicorns, $3.5 trillion. And I'm sure our listeners got a real good education on some of the challenges we're seeing, both in the short term with the value dislocations and the bid-ask spread issues, but also in the longer term, what's needed from a regulation perspective and just a market making and a marketplace perspective to provide more liquidity for more investors of all sides, LPs, GPs, employees. Lots of people have stakes in this game. And I really want to thank you for coming by the show today to help explain to our listeners what it's all about.
It's my pleasure, Hugh. Thank you so much for having me.
I'm Hugh MacArthur. Thank you for listening.